Welcome to MarketTamer.com. You're looking at a chart of the US dollar, and we can see that the dollar has declined quite substantially since the March period. And if you're listening to comments, for example, yesterday from the Federal Reserve suggesting that they would support the dollar, it's worth taking those comments with a grain of salt. And the reason is just looking at the trend over the past 7-8 months as well as the trend over the past 8 years or so. The trend has been very much in favor of a declining dollar. And so in some respects, we have to ask, why would it be in the interests of policymakers to favor a weakened dollar in spite of their claims that they support a strengthened dollar? And the answer to that may be found in net exports. Essentially what we find is when the dollar declines, when it gets weaker, exports increase, and we also find imports tend to decrease. And that's fairly straightforward, given that from the perspective of foreigners, U.S. goods are cheaper, and from the perspective of U.S. purchasers, foreign goods are more expensive. So the bottom line is an increase in net exports, an increase in aggregate demand, and a boost to GDP. Obviously, there's a consequence to this, and if we take a look now at the next chart, just keep in mind as we move to the next chart, just keep in mind this trend of the dollar from around the 90 region all the way to 75 in November. Now we'll move to the S&P 500 over that same period, and note the trend in the S&P 500. We've had a tremendous rally all the way up through November from March. So the question that might arise is how much real wealth has actually accumulated over this period, because the easy thing to do when looking at these charts is to note the nominal price increase and see that from the absolute low around 666 all the way up to the most recent high right around 1109. It's been a very substantial rally in nominal terms. The question then is that same rally taking place in real terms? That is purchasing power keeping up with the increase in nominal prices? And to answer that, we just need to go back to the dollar and ask, has the dollar remained constant through that period? And we see obviously it hasn't. It's declined very substantially. And so that means that much of the nominal increase in the S&P 500 is being offset by a weakened currency. Now obviously the prices will change right away in terms of the dollar. Doesn't necessarily mean imports will change right away. It could mean the quantities change over time. So we actually could see a decline in net exports for a small period of time, but ultimately net exports would increase as the quantities change to reflect the changing prices. So with that, the takeaway is that to really maintain and preserve wealth in this environment, the key is not just to note nominal prices, not just look at given price charts, which is the easy temptation, but make sure that we're keeping up our wealth and preserving and growing wealth in real terms. And one of the best ways to do that is not just to focus on U.S. stocks and U.S. companies, given that there's tremendous exposure to the U.S. dollar, but to look maybe towards foreign stocks, maybe look at other symbols such as EWZ for Brazil or the FXI for China. And beyond that, if you are sticking with US stocks, take a look at stocks that have a lot of exposure to the rest of the world. For example, McDonald's is a classic stock that derives a lot of its revenues and income from the rest of the world. And that essentially allows you to take advantage of US stocks while gaining exposure to the rest of the world, and it means that you're balancing the currency risks implicit in the purchase of a U.S. stock that has that exposure. So with that said, we wish you a wonderful day, and if you have any questions, as always, please don't hesitate to ask us at MarketTamer.com.